right, everybody. Welcome to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week's topic, we are doing types of life insurance explained. And what we mean by that is there's a whole slew of different types of life insurance out there. And it gets a little confusing sometimes, a little daunting for people. And all we want to do is break it down, try to make it easy to understand and grasp what each of them does, good, bad about them, and maybe who would be most appropriate for those types of insurance. Before we get started, just a little quick housekeeping. Just know we are recording this event. The event is being shared on our YouTube channel. It gets shared on our website. So just ask that you keep your microphones muted. You don't have to worry about the cameras because the only thing that's being shown is what's being presented on the screen. However, there is a chat box. So if you do have questions, please type them into the chat box. And that way, my co-pilot, who I'll introduce in a second, will be there to sort of, field those questions, throw them out to see if there's something that we need from the general audience to answer, and also to try to keep me on pace as I am flying this unwieldy machine here. All right, so your pilots, your presenters for tonight. My name is Tom Alessi. I am the president of the ARIES Foundation. I have been in financial services now into my 24th year. I'm an investment advisor. That means that I act as a fiduciary whenever giving guidance or advice to any of my clients. I want to introduce my vice president, Craig. Why don't you introduce yourself?
Sure. So I'm Craig Richardson, vice president of the ARIES Foundation. I've been in financial services a little over 18 years now, and my specialty is working with families to help them define their financial goals and have a better future with their money.
And Craig will be joining us as we go along this evening. Like I said, he's also there in case some questions pop into the chat box. Try to keep this flight on time as we move along here. We did tell you that Think with a Drink is brought to you by the ARIES Foundation for Financial Education. You can visit us at www.ariesfoundation.org. We are a nonprofit whose mission is dedicated to the idea or concept of trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are in a relationship with money. And just like every other personal relationship that you have in your life, there are triggers and emotional behaviors that occur that cause us to act irrationally sometimes when we're dealing with our finances. All myself, Craig, the rest of the ARIES team tries to do is try to help everybody take a little step back and take some of that emotion out of the equation. These are just way too many words on the screen, Craig, for me to do. So just understand, we're a nonprofit. This presentation is meant to be educational. We share it on our YouTube channel. We share it on our website, like we said. All we ask is that if you are going to do that, that you share it in an educational manner as well. Myself, Craig, the rest of the ARIES team, however, does say that if you do ever have any questions, whether they be legal, tax, or financial, that you seek out the help of a professional to get those questions answered. Okay, we got through that part. Now we get to the fun part of the evening, which is, hey, we call this Think with a Drink. And the reason for that is we understand that sometimes financial information, some of this stuff gets a little unwieldy, gets a little, daunting for some people, and they're challenged by it. And so all we try to do with Think with a Drink is make it more relatable, put it in a casual and more relaxed atmosphere. And we can't think of a better way to do that than as if we have something to sip on as we're going along. And for this evening, I have chosen, this is Ship Shape. This is a Czech-style Pilsner from our friends at Treehouse Brewing. If you don't know the story behind Treehouse, they're out in Charlton, but they have a couple of ones in Deerfield and another one they just opened on the Cape. That if you ever get a chance to stop by, you have to stop by because the beer is phenomenal and the amount of taps that they have is great in terms of the beer that's available. But Ship Shape is a Czech Pilsner. Done with Bohemian, in the style, which is, Bohemian malts and Saaz, that's SAAZ hops, right? So, certainly a very, very drinkable beer on a hot day. And of course, going into more hot weather, it's going to get humid as we go here through the rest of the week. But one of the things was we talked about this before with some ideas on pairings, which I think we want to add in a little bit here as we do this. So if you're ever out and you're ordering like like nachos or pulled pork, or even better, pulled pork nachos type of thing, right?
Yes.
Perfect pairing for a Czech-style Pilsner,
I love
right?
it. Definitely
So
upscale pairing of beer and pork nachos. I like it.
yes, well, it's a very good one for it. So if I'm never going to get too high class with you. Let's face that, right? So pulled pork nachos is as high as we're going.
What's the
What do you got
best
this
wine?
evening, Craig? What are you drinking?
I'm actually going Treehouse as well, and I'm drinking Juice Machine.
Oh, so that's out of the Julius line there in
It
terms
absolutely
of
is, yeah, with unforgiving flavors of mango and orange. And it's really cool is they have the robot on the label from Lost in Space, right?
okay. I can't see it that well, but are we sure that's not the Jetsons?
It's not the Jetsons. That's Rosie. That's the maid. This is that one of those first robots from the 60s with the globe head and the two black arms.
Oh yeah, yeah. Dr. Smith, warning, warning.
Yes, 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 that one. Yep.
Oh, interesting. Very nice. Well, here's the skull.
Oh,
Kick it off with is term insurance, right? So term insurance, for as basic as you can get with term insurance, is that term insurance, the idea behind it is covering you for a period of time from point A to point B. And that term can be anywhere from 1 years to 30 years. I know there are some providers out there that go to 40, but they're very, it depends on age, and there's not too many. It's tough to find of that 40-year. Most term policies, Craig, that we run into are usually 20 or 30 years, right?
yeah, usually the max is 30 years. And you're right, common term, anything from 1 out to 30, and you're usually in 5-year in periods. 5,
Correct.
15.
Yeah.
Mm-hmm.
And even today, right? The flip side of that, he mentioned that the 1 year thing. It's what's known as annual renewable term. That's ART. Again, that's another one. It's not that common to find anymore.
No, and for a good reason. I mean, part of the issue with 1-year term is that it increases a little bit every year for the same amount of coverage.
Right.
So wasn't as didn't stay that popular when you can lock in a rate for a given period of time.
Yeah. That's the idea behind it. So like that, what term does is it covers you for that period of time. It's very inexpensive, and it builds up no cash value. Essentially, that if you live from point A to point B, the insurance company keeps all your money. What you had for this was peace of mind. Term insurance should be thought of like homeowners or car insurance. I mean, even more so, because you never want to have to use this, because if you use this, that means you're dead.
Yeah, I mean, the really nice thing about term insurance, especially if you're younger, starting a family, and you have a lot of liability, right? So a lot of people in your home are dependent on your income and you being there and producing. And all of a sudden you're not. You might have, like I said, a large liability, because liability is going to be, based cost of, what your value is as far as production value, human life value.
Right.
It's not about what you're worth to other people. It's about what kind of much income would you have generated should you have been alive, right? And if you're young, your human life value is high because you have potential to earn a lot more money over that time period.
Right, because it's your whole working career, essentially, is what you end up there with.
Right. Well, it can get very expensive, and we'll talk about other types of insurance. With other types of insurance, well, term allows you to cover a lot of liability for a very small dollar.
Right. And one of the real reasons behind that is because of all the death claims that get paid out in the insurance world, less than 2% of them get paid by term insurance.
That's correct.
So if you really take a look at this and not to really, doom and gloom too much on it, but the idea is if they underwrite you or some company says we're going to cover you for 20 years, the likelihood is you're going to live for 20 years.
Oh, I don't think that's doom and gloom. I think of that as a positive. You get a free medical exam, and if you get qualified, you're absolutely going to live for the term.
You're going to live for the term. But then at the end of the term, guess what? They've kept all your money. You don't have any more insurance, and hoo-hoo, you're alive. That's it. It's one of the reasons that you hear the ads for on TV and radio and those financial entertainers, Susie and Dave. They're all doing it because they know they're not going to pay out the death benefit.
Right.
They've got all the tools and calculators and actuarial tables and guys who get paid just to go through this and determine it. So, as Craig said, if you're looking at this from who would benefit the most from taking out a term policy, as Craig said, young families looking to cover debt obligations, liabilities, and hey, what happens out into the future?
Yeah, and sometimes too, let's say you're taking out a business loan to do a startup. Sometimes banks will make you take out a term policy to kind of secure the loan, right? Because if you die in the middle of it, they get some kind of payback.
Correct.
So there's lots of reasons to have term. It's also a great placeholder. It allows you to buy a lot of insurance while you're young and healthy, which, we all get older every year. And usually as we get older, we don't get healthier.
Right. Right. Like we say, you can always, there are steps you can make. If you're a smoker, you can stop smoking. If you overeat, you can cut back on your eating. You can start exercising, things you can do to try to get healthier, but you can never get younger.
Well, not yet, not till they invent the time machine, but yes, other than that. But the other thing too is, we also will talk about term insurance as being like renting versus buying the house.
Right.
Sometimes you want to look at what kind of riders of term insurance, or these are extra benefits they'll give you that can make, maybe turning the term insurance from renting to with an option to buy, right?
Right. They are renting to own type of thing.
Renting to own type thing, right? So it's convertible to other things. Sometimes also you can get riders that include disability coverage that are built in.
Right.
That allows you. So there's lots of reasons to, the term is not an evil thing. But
yeah, no. I mean, it just depends on what you're trying to do.
The right tool for the right job. Exactly.
Yeah. All right. So moving on to, at least I think this is where I'm moving to. Yeah. So now we move into the categories of what, now that's term, which again is just covering you from A to B type of thing. Now we move into permanent insurance. So permanent life insurance works differently because, let's face it, I understand most of us think we are Superman or immortal or vampires or whatever, but we're all going to die at some point. So having permanent insurance means that it's going to be there so long as the premiums are paid when you die. So it becomes more expensive than term just on the idea that they know they're going to pay the death claim.
Yeah, and actually permanent insurance is really good for those people who aren't going to die. And the reason for that is because it actually endows at a certain point in time.
Right.
So if you want to beat the life insurance by living past the age of 100 or 121, whatever the whole the permanent insurance is based on, then you get the face value in cash. So
right.
The goal, live to be 120 so you can get the insurance company.
Live a really, really long time. So let's start with the basic, right? So this is what is known as universal life. Okay. So the way universal life works is you pay a premium to the life insurance company. The life insurance company then deducts what they call the cost of insurance from that premium. They then take from that any other expenses that go along with the cost of the policy, and they credit you usually an interest rate or a dividend payment type of thing on an annual basis. It's permanent, so it's going to be more expensive than term insurance. It, however, is going to build up cash value for you. So cash value that can be used to do other things, such as offset future premiums, be used to pay for something else, etc. The cash is yours that you can do.
Yeah, and I'd be, I don't know if I would call it more expensive. I would say the premiums you're paying up front are higher, but over time, permanent coverage can actually be less expensive than temporary coverage.
Well, you're talking about the annual, but I'm just talking about when we initially when somebody looks at a premium and, the term coverage is $100 and the permanent coverage is, $500.
Right. It can be more affordable. It's not necessarily cheaper.
Correct. Right. No. So, so what Universal Life does is there's two different versions of all of the Universal Life, because we'll have more policies that come off this chassis. But basically, you can do one of two things with the death benefit. You can have the death benefit stay static. It means, like, say it was $100,000. That means the policy is always going to pay $100,000 regardless of what happens. Or you can have it be the death benefit plus whatever the cash value is accruing to. So now you have $100,000, and if in 20 years there's 25,000 in there, the policy death benefit would now be 125,000.
Mhm.
Here's what happens with that. The problem is that cost of insurance, like Craig talked about, with that annual renewable term increasing every year. That's what happens in this policy. When Universal Life looks at the cost of insurance, they're going to look at what age you are every year. And they're going to look about how much they're on the hook for in terms of coverage of the death benefit. So if you don't have a static death benefit, if you're trying to cover the cash value at the same time, that means in the scenario we talked about, you're always got $100,000 of death benefit. It's going to get more expensive out over time. And it's going to eat away at the cash value that's growing in the policy.
Right. Yeah. And it's another one of those things where you just want to be reading the small print, because what is the cost of insurance increase going to be on an annual basis? What guarantees are there based on the crediting? Usually with UL policies, there aren't a guarantee on the crediting. And also expenses, while they may start low, they may have a cap that may be far higher than you would anticipate. So
Right.
it also becomes something that it gets variable. The only reason we say that is I've seen these types of policies actually implode on people, where they actually have to dump more cash than expected into them to keep them.
Oh yeah. Yeah. No. I mean, that's what it's part of that. So there's some of that you've got, like Craig said. So it's more of, as somebody is going through this with you, or you're looking at one of these policies, you just want to understand all of those fees and charges and expenses, and not so much, hey, what it's going to mean in the first 5 years, but what it's going to mean maybe out in the 20 or 25 years out, and what that can do to the policy. Because, as Craig said, these things can cannibalize themselves, and you could literally be paying more than what the actual value into the policy is, which means it's eating away at its cash, and it eventually just, as Craig called it, self-implodes.
Yeah, and like you said, they don't do it when they're young. They do it when they're older, and it may be more difficult to replace that insurance at that point.
Right. That's where the hiccup is. So, Universal Life has a place, but you need to be very careful about the provider, about the company that you're dealing with. And like Craig said, it's like anything else. Just do a little due diligence in there if you're looking at it and going through it. The next one up is sort of, we move off of just the UL. It's still in the UL chassis, so same sort of concept. It's called an indexed universal life. And now what happens with an indexed universal life is that instead of that interest that's getting paid into the policy, you are choosing, much like a fixed annuity, you're choosing either the S&P or some index, the S&P 500 or some version of a market index that the crediting to the policy is then based off. And where this becomes a problem is there are costs. We've talked about the cost of insurance. There are fees that are coming out of this policy. But at the same time, if there's no crediting, then where's the money coming from?
Right. It's the same thing as the first, but it gives you an opportunity to possibly have more growth in the policy because you're participating in these indexes, which is basically just like I said, the S&P 500 is an example of a benchmark. If it goes up by a certain amount, you're participating in some of that growth without any risk of the downside.
Right.
Right. So the issue is you're giving up that that dividend opportunity for the indexing opportunity. So this is something that may be a little more for a more advanced investor or a more advanced, part of your portfolio. But once again, it does have a place. It's just a matter of what you're trying to accomplish.
Right. And one of the things with this one and the next one we're going to talk about, is Craig meant that maybe a little bit more, involved, in terms of it, but it's also for somebody who's going to what we call overfund. Instead of paying the minimum premium in those first 5 or 10 years, putting more money into the policy, which is allowed to do, which just, it increases the ability of the policy running forever in that situation.
Yeah, the issue is, why would you overfund a policy? And there's lots of reasons, right? Do you want to give one, or you want me just to give a couple?
Well, so in the case of doing it, because what you're doing is, in the early years, the cost of insurance is less, so they're going to take less away from it. You're building up the reserve and the cash there. And as Craig said, if you are participating in the market and you're getting some boost or some increase, you're increasing more out over time.
Right. And also the additional funds you're putting in, you've already paid the cost of insurance and the expenses. So all that is going into cash value. And, life insurance policy, your earnings are tax deferred. So,
Correct.
So it's another way of putting away some money for those people too who can't do a Roth or some other account because they don't qualify. It's another way to put away money on a tax deferred basis.
Right. So it does allow you to do that, and you can add more in than you wish to. You have the ability to overfund. One of the nice things with both the universal life, the indexed universal life, and the next one we're going to bring in is they allow you to make, it's not hey, you got to pay this amount like term. I got to pay this amount every month no matter what. Right. You can pay a little bit, you can pay a lot, you can use some of the money that's in the cash to offset it. It's flexible in terms of the premium payment scheduling that you can do with these policies. The problem is, if you get, too much on that or underfund, you can run into the problem of not having the policy stay in force.
Right. So this isn't for the person who's running a strict budget who can't afford any fluctuation, right? This is, you have some extra money to play with and you want to get some extra value out of it.
Like Craig said, like one of the places this really fits is for those people who are, income out of a Roth. This is a nice way to fill in into terms of the Roth idea. So similar concept, but unlike the Roth, this gives you that, hey, look at it, if I passed in 2 years, my beneficiaries, my wife, my family are going to get a bucket full of money that I wouldn't have had if I just opened a Roth.
It's a self-completing Roth.